qualified retirement plans follow certain rules. The majority of rules that they follow are what we call ERISA. ERISA stands for Employee Retirement Income Security Act. It was originally passed in 1974. Before ERISA, you could work somewhere your whole life, and right before you were going to retire, they'd fire you and you'd lose whatever they had put in for you, and that was just wrong. So ERISA came along and set forth eligibility rules, non-discrimination rules, vesting rules. So this idea that qualified plans must follow ERISA, they must be fair. There is something called a non-qualified plan. Deferred compensation is an example of a non-qualified plan, one that does not follow ERISA. Deferred compensation is set up in favor of higher paid workers. It's discriminatory. It's not currently funded. So if you say to your favorite employee, work for me for the next 20 years, I'll keep you on the payroll. That's basically what deferred compensation is. Once you retire, I'll keep you on the payroll. But then the employer goes broke the year before they're set to retire. What are they going to get paid? Nothing. Non-qualified plans include deferred compensation, does not follow ERISA, discriminatory, unfunded. Non-qualified plans offer no special tax benefits to the employer. Qualified plans must be non-discriminatory. You can't say, oh, I'll put 10% in for the workers that have been here for 5 years and 2% in for those in their first year. No. It's got to be the same for everybody. So qualified plans generally are set up either as a defined benefit plan, or more common today we see what are called defined contributions. Both are types of qualified plans, defined benefits or defined contribution. A defined benefit plan promises a specified monthly benefit at retirement. The plan may state this promised benefit as an exact dollar amount, such as $100 a month at retirement, or more commonly, it may calculate a benefit through a plan formula that considers such factors as salary and service. For example, 1% of average salary for the last 5 years of employment for every year of service with an employer. The benefits in most traditional defined benefit plans are protected with certain limitations by federal insurance that is provided through the Pension Benefit Guaranty Corporation, what we call the PBGC. So ERISA set up the PBGC to protect people that had defined benefit plans when their companies went broke. So for example, United Airlines had a defined benefit plan. The assets went into the PBGC upon their bankruptcy filing, and the pilots who had worked there for 35 years, who thought they were going to make $100,000 a year in retirement, in fact only got around $35,000. So it's not a guarantee of what you were promised. Oftentimes defined benefit plans aren't funded properly. They need to be funded to pay the promised benefits. So you see less and less employers currently doing defined benefit plans, and more employers going to this defined contribution plan. Defined contribution plans are not protected by the PBGC. They are not. A defined contribution plan does not promise a specific amount of benefits at retirement, so that's a much safer thing for an employer to do. In a defined contribution plan, the employee or the employer, or both, very commonly both, contribute to the employee's individual account under the plan, sometimes at a set rate, such as 3% of the employee's earnings annually, or a 2% match, or a 50 cent to $1 match, or however it's set up. Most commonly, they're done in some sort of a matching way, though. So if it says we'll match up to 3% and the employee puts in 2%, well then the employer only puts in 2%. Not always, but very oftentimes they are. These contributions are invested on the employee's behalf. The employee will ultimately receive the balance in their account, which is based on contributions plus or minus investment gains or losses. The value of the account will fluctuate due to the changes in the value of the investments. We're commonly in things like mutual funds. I read a statistic, I'm not going to remember it off the top of my head, but most people's first experience with purchasing securities is in a mutual fund retirement account type plan at work. Defined contribution plans include people's 401ks, 403bs, which are 403bs fall under Internal Revenue Code 401k, Internal Revenue Code 403b, employee stock ownership plans, profit sharing plans. So defined benefit, not as common today as defined contribution. Both are types of qualified plans. So whichever one the company sets up is fine. They can't be discriminatory. They must be the same for everyone. Who must be included under a qualified plan? Now this is generally speaking. There are slight exceptions that get pointed out along the way. But generally speaking, eligibility under ERISA, generally speaking, if your employee is 21 years of age, they've been there 1 year, and they are full-time, and the employer has a qualified plan, it must include them. Which is not to say that the employer couldn't say, the minute you start, I don't care how old you are, I don't care if you're part-time, we'll include you. They can always do that. The eligibility, this is just the worst it can be. 1 year, 21 years of age, and full-time. Vesting. Vesting means ownership. So ERISA sets forth vesting requirements as well. The minute you make your own contribution, that money belongs to you. It's your money. So when we talk about vesting here, we're talking about the employee ownership of employer contributions. So generally speaking, qualified plans will follow one of these two vesting schedules. There's a cliff vesting schedule and there is a graded vesting schedule. Now they can always be better than these, they just can't be worse than these. So the 3-year vesting schedule says that at the end of 3 years of making contributions, at the end of the 3rd year, the employee jumps off the cliff. They're 100% vested in their employer contributions. The graded schedule works like this. By the end of the 2nd year of contributions, the employee must be 20% vested. 3rd year, 40%. 4th year, 60%. 5th year, 80%. So that by the end of the 6th year, they are 100% vested. That's the graded vesting schedule. What's the whole point of having vesting schedules? To retain good employees. Employees are expensive to train. So these vesting schedules are designed to give the employee encouragement to stick around. I had a girlfriend, she was working at a company that shall remain nameless. She said, you know, I have 6 more months till I'm 100% vested. She had a cliff vesting schedule. She said, I'd rather die, and she quit. I thought, oh, but at least she thought about it, right? So that's the whole point behind these vesting schedules. Once again, the employer can always make it better than these, but never worse than these. Distributions from qualified plans. So all qualified plans have these similar sets of rules. Distributions made in the event of retirement usually take one of 2 forms. They can take a lump sum distribution, 100% taxable lump sum, or a series of monthly periodic payments. If any form of annuity is provided, the plan must make available a qualified joint and survivor annuity. So when you have the ability to choose joint and survivor as an annuity payout option, what that means is that payments will last until the last party dies. The IRS now mandates that unisex annuity tables be used when purchasing annuities for new retirees. A lump sum distribution is one in which a participant's entire retirement account balance is paid out in 1 year and taxable in the year of distribution. Under either an annuity payout or a lump sum payout, the participant recovers his or her cost basis tax-free but generally there's a zero cost basis in these qualified plans. The balance that has not yet been taxed, which is usually 100% of the account balance, is taxable how? As ordinary income. An individual's cost basis is whatever they've put in that was not tax deductible. And generally speaking, in qualified plans, we don't have that. Generally speaking, we don't. If the participant made no contributions, then their cost basis is zero. Well, sure, the employer contributions are always tax deductible. Employee contributions are usually also tax deductible. That's why we fund these qualified plans that we have at work. Most of the time, qualified plans have a zero cost basis. Another way you can get a distribution out of a qualified plan would be due to disability. If you're taking money out of your qualified plan due to disability, they will waive the 10% early withdrawal penalty. They will also waive the penalty if the distribution is being made due to the participant's death. Upon death of a plan participant, if payments are made in monthly or periodic installments, the recipient beneficiary pays income taxes on them just as the retiree would have had to have done. Taxable is ordinary income, whatever has not yet been taxed. What happens when an employee terminates their employment? Plan participants who terminate employment prior to normal retirement age are entitled to their vested account balances. These distributions are taxed in the same manner as any made at retirement. If under age 59 and a half, one option the terminated employee may elect is to roll over his or her distribution to a conduit IRA. We talked about the rollover IRA. Then from the conduit IRA to the plan in place under his or her new employer. This approach postpones taxes and there's no penalty. If you're taking your money out because you left your employer, you're under age 59 and a half, you put it into this rollover IRA, conduit IRA, you can get it into the qualified plan at your new job and you will owe no taxes. Rollovers must be made within 60 days of a distribution in order to avoid current taxation. Trustee to trustee rollovers avoid any withholding taxes. So if you get it directly from one trustee of a retirement plan paid into the trustee of your new retirement plan, that's the easiest way to do it. Premature distributions are any distribution from a qualified plan that is made prior to age 59 and a half. In addition to the distribution being taxable as ordinary income, there's a 10% penalty. We talked about that. Unless the employee has died or become disabled. Those are the two big exceptions. Types of qualified plans. Not discussing limits yet. That's the next video. A 401k. So the employer provides its employees with a way to reduce taxable income, establish a retirement account, enables retirement savings to grow on a tax-deferred basis, can tailor the fund investments to the employee's goals. The 401k, is there limits? Yes, just like there's limits into the IRA. Is there limits to fund variable annuity? No. The employer can contribute and the employee can contribute into the 401k. Withdrawals are taxable at ordinary income rates, subject to early withdrawal penalties, with the exception of no penalty if you're over age, well, if you're age 59 and a half or older, no penalty due to death or disability, retirement or other separation from service. You always have to pay taxes. Roth 401ks became available January 1st of 2006. Similar to a Roth IRA with some slight differences. So really, employers have to choose whether or not they want to allow their employees the ability to have a Roth 401k. So if they have a normal 401k, it's always pre-tax dollars that go into that, the employees' pre-tax dollars. If the employer allows them to put after-tax dollars into the Roth 401k portion of the account, that's possible. So Roth 401ks funded with after-tax dollars. It does have a must-begin distribution by age 70 and a half rule, which did not apply to the normal Roth IRA. It does not have the 5-year rule. So remember, in a Roth IRA, to have the earnings be federally income tax free, the account must have been opened a minimum of 5 years, paid out on or after 59 and a half. So the Roth 401k must begin distributions by 70 and a half, but the earnings will be federally income tax free no matter how long the 5-year rule does not apply, no matter how long the account has been opened. A SEP, Simplified Employee Pension Plan. A SEP is an IRA established and maintained solely by the employee, but to which his or her employer may contribute. There's eligibility requirements, contribution limits, there's vesting. A SEP has the simplicity of an IRA, but higher contribution limits than an IRA. We'll talk about it in further detail in the next section. Simple plans. SIMPLE stands for Savings Incentive Match Plan for Employees. A SIMPLE is a simplified retirement plan for small employers with 100 or fewer employees. The SIMPLE plan has something that's unique about it. A 100 or fewer employees. The eligibility for a SIMPLE is not the same as it was before. Not the 21 1-year and full-time. It has to do with anyone who worked for the employer in the previous year who had $5,000 in compensation. If that's the case, then they must be allowed this year to participate in the SIMPLE account. Employee contributions to a SIMPLE may only be made through a qualified salary deduction plan according to a set percentage of compensation. So the employee chooses, do they want to put money in? 1%, 2%, 3%, 10%, whatever. Employer contributions may be made either as a dollar-for-dollar matching contribution. So it's up to the employer to choose. Do they want to do a match? That's one of the things that they can do, match 1 to 3%, or the employer can choose to do what's called a non-elective contribution. So I'll explain the difference. So if the SIMPLE is set up as a 3% match and your employee who is eligible does not contribute, how much does the employer have to put in? 0. If it's set up as a 3% match and the employee puts in 1%, how much does the employer have to put in? 1%. So that's how the match works. The employer could choose instead to do a non-elective contribution of 2%, which means that everybody who's eligible, no matter what they contribute, 0 or 15%, it doesn't matter, the employer puts in for everybody 2% of the employee's salary level. So it's up to the employer how they do it. Something else that is unique to a SIMPLE, employees vest in employer contributions immediately. That's unique. Because of that unique situation where vesting in your employer contributions happens right away, the IRS says if there's any early withdrawals made in the first 2 years of the plan, it has a 25% IRS early withdrawal penalty. So this is really done to encourage people to not take it out right away. So 25% early withdrawal penalty to any withdrawal made in the first 2 years of a person's eligibility in the SIMPLE account. So that's pretty significant. So those are some unique features that SIMPLE plans have. A KEO. KEO plans are sometimes called HR 10s. The KEO Act provided that self-employed individuals who pay Social Security taxes are to be treated for qualified retirement plan purposes as employees of their businesses. So generally speaking, self-employed people, they're eligible to either, of course, anytime you have earned income, you can have an IRA. But when you're self-employed, you can have a KEO. You could also set up the SEP IRA. A lot of self-employed people set up a SEP IRA, so really either one. They both have contribution limits. There's some slight variances on, when can you fund it and which one can you put in how much in. There's little bits of differences that we'll learn in the next section. Let's say you have a job where you have a 401k, so you fund your 401k. Can you have an IRA? Well, of course, you have earned income. What if you have a consulting business on the side and someone pays you as a 1099 employee? Can you also have a SEP IRA or a KEO? You better believe it. So you certainly could have all three. Only self-employed people who have earned income can establish a KEO. Earned income can be defined as earnings attributed to a sole proprietorship, a partnership, or an unincorporated business. Corporations are not eligible for KEOs. Eligibility for KEO plans, they are set up as defined contribution qualified plans. I might be self-employed and have an employee. Does that mean I can put in 10% for me and 2% for my worker? No, it has to be non-discriminatory. The same percentage for all workers. So the same, if I put in 10 for me, I put in 10% for everyone. Persons who have worked there for 1 year, 21 years of age and full-time are eligible for the KEO. All of the other rules are the same. Cost basis is 0, taxable is ordinary income upon withdrawal, rollovers are permitted. Distributions must begin no later than April 1st of the year after the participant turns 70 and a half. TSAs, tax sheltered annuities, Internal Revenue Code 403B. So 403B, tax sheltered annuities. It is the only annuity funded with pre-tax dollars. So a zero cost basis, pre-tax dollars. They're for public school employees and nonprofits. So not private schools, but public schools. The janitor at the public school, the teacher at the public school, not the children at the public school. They are retirement plans. They follow ERISA. Money goes in pre-tax dollars, 100% taxable ordinary income upon withdrawal. Eligibility is the same as always, 21 years of age, 1 year of service and full time. There is limits. All of these have limits. You'll see them in a moment. Money taken out under 59 and a half has a 10% early withdrawal penalty. Taxation of distributions, if you take out a lump sum, it's 100% taxable because your cost basis is 0. If you annuitize, your taxes owed are spread out over time, but your cost basis is still 0. Ordinary income upon withdrawal or upon receiving those payments. If you take money out of your TSA under age 59 and a half, we owe ordinary income plus a 10% penalty. That has not changed. They do allow a slightly longer list of reasons why they'll waive in a TSA the 10% penalty. So death, disability, divorce, lifetime or joint lifetime annuity, financial hardship, policy plan loan, a rollover contribution. So those are reasons why the TSA, the tax sheltered annuity, would waive the 10% early withdrawal penalty. Money purchase plans. A money purchase plan is a type of a tax-qualified defined contribution pension plan that requires employers to contribute a fixed percentage of compensation to each eligible employee annually. These plans may be set up by businesses of any size or by individuals with self-employment income. This type of arrangement is different than a profit-sharing plan, whose contributions are discretionary rather than mandatory. The plan states the contribution percentage that is required, where profit-sharing plans can choose some years to contribute and some years not to. Money purchase plans cannot do that. For example, if the percentage is 5%, the employer in a money purchase plan must make an annual contribution of 5% of each eligible employee's pay to their separate account. The employee's account balance at retirement, which is based upon the amounts contributed and gains or losses in their separate account over time, determines or purchases the amount of their retirement benefits. Employer and or employee contributions are permitted in a money purchase plan. Maximum contribution amounts are subject to change over the years. Employer contributions are tax deductible as a business expense, and employers may establish vesting schedules and exclude certain employees as allowed to do so by ERISA. Annual top-heavy testing is also required, which ensures that the benefits that accrue to key employees do not exceed 60% of the benefits that accrue for all employees. Employee contributions and plan earnings are tax-deferred until withdrawn, like any other qualified plan. Plan loans may be permitted, plan withdrawals may be restricted, and investment decisions may be controlled by the employer. Contributions to profit-sharing plans are discretionary. There is no set amount that employers have to contribute. If contributions are made, they must be made according to a set formula that determines how contributions will be divided. The money goes into a separate account for each employee. Profit-sharing plans may be set up by businesses of any size or by individuals with self-employment income. Plans are funded solely by employer contributions, which may be either fixed or discretionary and are generally based upon company profits. Maximum contribution amounts are adjusted annually. Employer contributions are tax deductible as a business expense. Employers can vary contributions from year to year or skip years as long as the contributions are generally substantial and recurring. Employer contributions and plan earnings are tax deferred for employees until withdrawn. Although loans may be permitted out of a profit-sharing plan, employers may exclude certain employees and may establish vesting schedules as permitted by ERISA. Top-heavy testing is also required to make sure the profit-sharing plan does not discriminate in favor of higher-paid employees. Employers may restrict withdrawals and may require employees to have 2 years of service in order to receive an annual contribution. Plan investment decisions may also be controlled by the employer. So in both the money purchase plan and in the profit-sharing plan, the employer can choose how to invest the money. I've seen many different companies that will have 401ks as well as profit-sharing plans. So it's possible where you work that you can have more than one type of qualified plan. But remember, the profit-sharing plan is 100% funded by the employer, and it's up to them if they fund it or if they don't, how they fund it, and what they put the money into is up to the employer. 457 plans are qualified plans. It's a defined contribution plan available for governmental employees and certain non-governmental entities that are tax exempt under Internal Revenue Code 501. It allows employees to defer compensation on a pre-tax basis, just like they all do. 457s are most similar to 401ks and 403bs. The main difference is that there is no 10% penalty for premature distribution in a 457 prior to age 59 and a half, although money taken out would be subject to ordinary income rates. Most 457 plans allow participants to increase, decrease, stop, or restart contributions as often as they wish. Participants may choose from a wide range of investment options selected by their employers. Governmental 457 plans may also be rolled into other types of retirement plans, including IRAs, with very few restrictions. However, non-governmental 457 plans may only be rolled over to another non-governmental 457 plan. Now remember, it's more in this section general rules about how qualified plans work, and then in the next section it's a quiz about do you remember what the limits are for each of these plans this year, because it changes every year, of course. Deferred compensation, I already told you, is a type of a non-qualified plan. It is discriminatory. Non-qualified plans do not follow ERISA. They don't have to. They're set up in favor of higher paid workers. They are unfunded. If the company goes broke, the employee won't get paid anything. Other tax advantaged plans. These two types of plans are ways in which we can save for educational expenses. There's two. There's what is called the Coverdell Educational Savings Account, and there's a 529 plan. Of the two, which one's more popular? Oh yeah, the 529 plan. The 529 plan is a type of a municipal security. It's a muni. They vary by state. The 529 plan is more popular because it has much higher contribution limitations. Now these vary by year, but generally speaking, okay, as a general rule, how much can you put into a 529 plan? 5 times the current year's gift tax exclusion amount. Both the 529 plan and the ESA, both of them, are funded with after-tax dollars. So I remember a few years back, my mom called me up and she said, I just read the most interesting article. Did you know I could put 5 times the current gift tax exclusion amount into Miles's 529 plan? And I said, I did. Did you know that you could also do it for Mason, for Max, and for Emery? And did you know so could Grandpa? She didn't think that was so funny. But you can. So you can get a lot of money. It's after-tax dollars going in, but you can get a lot of money in there in a fairly quick period of time. Now, how big can the account grow to varies by state. So quite large. The earnings are federally income tax free in a 529 plan if the earnings are used for higher educational expenses. So 529 plans are for higher, so after high school, higher educational expenses. So if I fund a 529 plan for my oldest, his name is Miles, it's out of Vermont. Does that mean he has to go to school in Vermont? No, he can go to school wherever he wants to go to school. Doesn't matter where the 529 plan is set up. It's true some states have tax benefits for having your client keep the money in that state's 529 plan. That's beyond the scope of this test. So you might want to look into that, talk to an accountant about how it works in your state. But the test here won't care about it. Anyone can set up a 529 plan. You don't have to be under age 18. Coverdell Educational Savings Accounts, they must be established for a minor, someone under age 18. So the 529 plan may be set up for anyone. So I can set myself up one now because I'm going to get my PhD when I'm like 70. Because I will, because I love school. I'm a total nerd. Yep. So I could set one up for myself now. Very commonly, what you do is you say, I'm Susie Rhodes, and it's for the benefit of Miles Rhodes. Or it's in my mom's name for the benefit of Mason Rhodes. Usually you don't put the 529 plan in a child's name. You can't do that. So it's got a beneficiary on it. If Miles doesn't use all the money in his 529 plan, I can roll it to Mason, I can roll it to Max. You can roll it quite a ways down. If when all is said and done, nobody needs money for higher educational expenses, I can take out the earnings. They'd be taxable at ordinary income rates plus a 10% penalty because I'm not using it for what it was established for. The money you put in is your cost basis. That always comes back to you tax-free, no penalty at any time. So qualified higher educational expenses, that's what the 529 plan is for. So why is the educational savings account still around? Because of various different reasons, but one of the big differences is that you can use the earnings, federally income tax free, for any educational expenses. So if you just had a baby and in your town you have a private high school that you'd really want to send this baby to when they're old enough, You can start saving for it the minute that they are born. But it does have a fairly low, much lower than the 529 plan limit. So that varies by year, so we'll talk about that in the next section of the course. But this is a big difference, where the 529 plan is higher educational expenses only. This is for private preschool, high school, elementary school, middle school, I don't care. If the money is not used, if the earnings are not used for educational expenses, you could even use it for higher educational expenses, ordinary income and a 10% penalty. The Coverdale ESA does have a use by age 30 rule, with the exception of special needs children who do not have to use the asset by age 30. So if I have an Coverdale Educational Savings Account set up for Miles and he doesn't use all the money in it, I can roll it to Mason, I can roll it to Max, I can roll it to Emery. I can roll it quite far down the family tree. So used to be called educational IRAs until somebody realized it's not a retirement account at all, so now it has this new name, Coverdale Educational Savings Account. Very low limit. You do not have to have earned income to fund either one of these, so retired grandma can fund one of these or both of these. You can have, a child could have both of these. But if you earn too much, you cannot fund the Coverdale Educational Savings Account. So it does have an income phase out, kind of like the Roth IRA had an income phase out. The Coverdale Educational Savings Account does have an income phase out, which will be discussed in the next section. So always a couple of questions about these tax advantaged plans. The advantage is the earnings will be not taxable when you take them out, so long as they're used for what they're set up for. So big difference, ESA, any educational expenses, whereas 529 plans, higher educational expenses. Not to buy my son a car to drive in college, no. Room and board, tuition, books, meal plan maybe, you know, things like that. That concludes our discussion for securities and tax regulations. That is a pretty big chapter. So hopefully I didn't lose you anywhere along the way. The good thing about having these online videos is you can just rewind me. Sometimes I know I can talk kind of quickly. You have key facts to read. Read those a few times. Always very helpful to read them the night before your test. They'll put you right to sleep and then you'll dream securities. Practice the section quiz. Your ultimate goal, to get to 90% or better. Have fun.